Welcome to this special webinar with Southern Impression Homes. I'm here with Jim Shields and Chris Funk, principals there at that firm. They've been advertising and sponsoring and partnering with us for some time. It was great to be in person with them at our recent WCI-Con this year. But welcome to the webinar, Jim and Chris.
Good to be here, Jim. Thanks for having us.
Yeah, thank you for having us. Really appreciate it.
Why don't we start out with a presentation that you have, and then we'll move into kind of a Q&A period after that.
Excellent.
So, Jim, why don't you go ahead and share your screen and start the presentation?
Okay. Well, we appreciate you guys being here today. Chris and I have been working with Whitecoat for, about 2 years. We were introduced to the group by our friend Don Warner over at DLP, which I'm sure a lot of you guys invest with. And, speaking with Jim and Brett, I know that, with the power of real estate and trying to get a supplemental income from, the medical careers, there's lots of great options out there. There's funds, there's syndications, which both Chris and I invest in. But I know Jim and Brett personally have invested in direct property ownership. And that's kind of where we've made our niche for helping investors. And Chris and I started over 20 years ago, been doing the bulk foreclosures for a very long time. And then about 10 years ago, we said, what if we started to build new properties for ourselves and investors instead of renovating old ones? So we became one of the forefront people getting into the build to rent, which means we build new construction rentals in high growth areas. And right now, our company has over $637 million under asset management, $44 million in recurring revenue. We've created over $158 million in equity for our investors. We're over 850 investors, developed over 7,500 units, housed over 8,000 people. Our team is over 170 and growing. And last year we did 182 million in sales. By our calculations, this has impacted over 375,000 families. And Chris and I have a clear goal to put this to 1 million. Our markets are really focused in high growth areas in Florida. We started in Jacksonville and moved over to Palm Coast and Ocala, Inverness, Citrus Springs, and then we're in about 7 different markets down in Southwest Florida, which is one of the fastest growing areas in the country. There's many reasons why we went into Florida, and because we were taught by mentors years ago that there are 5 driving factors to a real estate market. That's economic growth, population growth, affordability, desirability, and healthy supply and demand. These are the things that really give strength to a market. This was one of the things that came out last week in Forbes. There was only one city in Florida that was in the top retirees, and that was Jacksonville, one of our hub markets, which doesn't surprise us because when it comes to affordability, desirability, healthy supply and demand, population growth, and economic growth, Jacksonville really has that, and we try to place that in the same markets for what we do. I did want to spend a little bit of time before we move on. Chris, did you want to talk a little bit about our merger, our acquisition that came up over the last year, and why that's good for our clients and our business?
Sure, Jim. Yeah. So, back in January of this year, January 2023, Sumitomo Forestry, through its wholly owned subsidiary Guillen Homes, which is also operates under the name Brightland Homes, purchased 80% of our operating companies. So Southern Impression Homes, Suncoast Property Management, and that acquisition has really enabled us to free up the capital side of our business. So, we're no longer utilizing third-party banks. It's a lot of internal capital. Sumitomo Forestry is a publicly traded company in Japan. So they're a 320-year-old company that started in the mining business in Japan many years ago, and has really gotten heavily involved in the U.S. housing market since about 1970. So it's really been a fantastic relationship, having the ability to operate as a private builder, still be nimble and be able to do what we do best, but have the backing of a public builder with the capital backing that comes with with a public company, without all the other strings attached. So it's really been great, obviously, for our operations, and for our ability to grow and scale out the business here in the years to come.
Yeah, And one of the reasons that we were excited for Brightland and Sumitomo to come on board is they were present all over the world, but they yet were not present in build to rent nor in Florida. And one of the things that they liked about Florida was just this. Now, this is a graph from the Federal Reserve. Uh, the One of the biggest things Chris and I have always looked for is population growth. When we're building houses and wanting to provide rental property, we always want to have people coming in. And this was a very powerful graph that we found from the Fed. So we like the Southeast, and you can see this. This is Florida. You can look since the 60s, Florida has been just on a hockey stick growth upwards. And that gives a lot of strength and growth for not only values, but also rental demand, which is so important when we're providing investment property. Opposed to like Alabama, which Chris and I like the Alabama market, we like the Southeast, but we always chose to go into places with more population growth. We found that to be more prudent and safe for our investors and for ourselves. And we always want that population to have that kind of trajectory. So one of the reasons Sumitomo joined with us, they saw bigger projections in Florida, especially over the next 10 years than we even saw, which was really exciting. We've been having a lot of common questions. People joke with me, gosh, you got used to, I invested many years ago for a long time out in California, moved for better fundamentals to Florida. They said, you got used to earthquakes, but now how about hurricanes? Chris and I have learned over the years, how do you navigate hurricanes? One of the nice things about new construction property is it is required now since 2004 to build on higher ground, stronger structural designs and materials. And even though we're building in coastal communities, most of our properties are built at least 5 miles inland. And when insurance companies look at that for the risk ratings, it's very favorable. In fact, everyone knows that in this past year, we had Hurricane Ian, which was one of the most powerful hurricanes to ever hit Florida. We were very heavily invested down there in projects. And we're proud to say out of hundreds of projects, we only had 4 that needed insurance claims. And an interesting fact, Jim, is these 4 were just freestanding walls. We hadn't had time to tie on the roofs, which really gives it the strength and integrity. So these freestanding walls were knocked over in the wind. So we had to file the insurance claims on them. But something very cool is there was no flooding. And something Chris and I have learned over the years, wind is a damaging thing in hurricanes that can be really dealt with, especially with stronger structural design. The flooding is something that you have to look for. And with building to higher ground, I'll be the first to say, sometimes when we're having to bring in all this extra dirt, Chris and I would be, hoeing and humming and groveling a little bit. But, it's kind of like when your parents used to tell you, put on your seatbelt when you first started driving with your friends, and yeah. So you get in that first accident, you're really glad you had your seatbelt on. And that's what we just experienced with Hurricane Ian. So we're pretty proud to see that it's worked well. And insurance, especially on our new construction properties, and a lot of investors with White Coat probably have been happily shocked to say, gosh, I've heard insurance would be so much more. It depends on the property. Older homes built at lower line levels, you're going to have really high insurance. In new construction, we've been getting great rates. Another thing, Jim, that's been coming up, and we've had a lot of questions from White Coat investors of recent, it was in the news. President Biden introduced a new mortgage, basically tax to good credit people to help subsidize high-risk mortgages. It was coming up to an average mortgage about $40 to $50 a month. And everyone's looking out for their cash flow. And they've come to us and said, Jim, Chris, what do you guys think is going to happen with this extra $40 to $50 a month that's going to take off of our cash flow? Here's what we've seen over the last 20 years. This is not a political slant in any way. It's just a fact of what we've seen in all government intervention when it comes into our markets. Normally, the intention of who things need to get put on gets passed down to someone else. And what we've already seen with this hike in mortgage payment, we believe over the next year, you're going to see this extra $40 and $50 get passed into rental properties in the rent rates. So we're really not concerned about that. So we don't see this having a big effect on our investors. We've had a lot of conversations over the last month about that. We've also had a lot of conversations, Jim, about incentives. And you and I have had conversations. Brett has had conversations with us. One of the biggest things that has slowed down the real estate market or given concern, it was not actually the market or the pricing or the rents. What it was those rates. In June of 2022, we also have just this incredible fast rise in interest rates. And we found that so many people would say to us, gosh, if we could have just locked in a year ago, a year and a half ago, things would be different. Well, Chris and I take that pretty seriously. And on a program that we have been working on for several months, we've been able to actually bring an in-house program in to help you go back in time and get those rates before this crazy jump. A lot of our people are going, how are you doing this? You have a 4.75 program. We just got quoted at 7%. And as Chris might talk about, I know you might want to add on this, Chris, we're in the business now of buying money. We're actually pre-buying loans that can be used on our properties only. And it's giving that back in time approach, 30-year amortization, 10-year fixed, and a 4.75. And to help our investors, we're giving 1 year free management. Chris, I don't know if you want to add anything on how this in-house program works, because it is pretty fascinating.
Sure. Yeah. So, as you mentioned, we've really focused on trying to find alternatives for our clients. So we have folks that are, scouring the lending world and the credit markets. And, one of the things that they came up with was this program that really, is not open to the general public. You have to be a builder doing a certain amount of volume, because you have to go buy chunks of money at a set interest rate. So, what we can do is go to the market, do a trade, and buy this low interest rate, and we have to buy them in large chunks. So, it's one of the areas where we're able to create synergies throughout our entire network, because we have folks buying homes every single day that are looking to take advantage of this rate. And so what we do is we lump a number of those amounts together, and we go and we secure the money at that 4.75% rate. And then we're able to give that rate to our clients when it's time for them to come close their house. So, it's a great product for, particularly for properties that are, near completion or complete currently, because, we're able to get that rate, and we're able to lock it in right now. We're not sure how long we're going to be able to do this. So that's why we're only locking for properties that are that are complete or very, very close to complete at this particular moment in time. But this is a program that we really like, and we found one source for this, and we're looking into others to make sure that we can offer this in the future. But for the time being, we have what we have, and we're willing to share it with all of our investors.
That's pretty exciting. I mean, you can't go out and buy a house you're going to live in at 4.75% right now, much less an investment property. So that's a pretty awesome deal. It just makes it much easier to turn a profit.
Yes. Yeah. We want to get people off on the right foot. We look at property long-term, Jim, as we've discussed. And if we can get in a great position right from the get-go, we know if history repeats itself, the building effect, especially if you're in the right areas, right property with the right management, we have a great future ahead. And being able to get in at this rate, we're separating ourselves and our investors from what other people are able to do, which is very exciting. And a lot of White Coat community people have already been getting qualified and getting in on some of our properties. And for our properties, we are offering this on all of our properties, single family, duplexes, and quads, and we've had people buying all over the array of these properties. And that's in all of our markets of things available. When you look at some of our properties now, these are things that our sales specialists will go over with you, but our overall caps are between 5 and 7%, going on single family right up to quads, and total return on investment with all of the tax benefits, deductions, depreciation, you're looking at about a total return of 26% when you add everything in, which is a great starting point. Same thing with Port Charlotte, it's another popular market in Southwest Florida. Again, we'll go through all these cap rates averaging between 5 and 7%, a great overall return. Duplexes in Palm Coast, we've had a number of people investing in the Palm Coast area with us through White Coat, one of my favorite markets. And that duplex, gives you 2 tenants under one roof, still one loan. With the 4.75 really does do well. even going up further. And we've actually just this week, I know, done some properties with White Coat community people on quadruplexes in Jacksonville, our hub market, which has had, again, a lot of attention over the last few weeks when Forbes announced it as one of the top new places for retirees. Because yes, retirees will move into our houses, Jim, but it's more the jobs that the new retirees coming to an area will provide. Those are the people living in our properties, which is a great replaceable income, hardworking class, which we want to work with. And again, producing great returns right off the get-go. A lot of that help from the 4.75. So we have able to contact our team for that, and that's pretty much our whole presentation, Jim. And just wanted to answer questions.
Awesome. Well, let's get into some of the questions. One interesting thing about Florida, and I obviously don't live in Florida, and so I see what goes into the national news. Well, what's in the national news in Florida is a lot of your governor, Governor DeSantis, and his battle with Disney, and some changes politically down there. Do you see any impacts of political changes in Florida the last few years on your markets or on your properties, either positive or negative?
I mean, I'll answer that first. And Chris and I have had lots of conversations on this. One of our principles now, Jim, or things to avoid, is the pitfalls that can come in a state where you can't collect rents is very real. And we had some friends in parts of California and upstate New York who had a really hard time collecting their rents through the pandemic. Right or wrong, when you have your own portfolio, that's something you really have to watch. In Florida, going through something as crazy as the pandemic, we saw that, and again, this isn't a political slant either way, we were able to collect rents. Issues we heard elsewhere were not. So I actually feel more confident in Florida, more successful. I got to be honest, our Georgia markets, which we've had, it was harder to collect rents. And for me personally, I just want to go where it's landlord friendly. And landlord friendly doesn't mean even slanted towards the landlord, but when push comes to shove, will I be able to collect my rents? So I actually believe through the pandemic and some of the craziness, we were able to be seen as a place where it's landlord accommodating, which I think is fair and has been helpful. Chris, I don't know if you have any opinion on that.
No, I second what you're saying. We saw in, what I would say in Georgia were some, very, very abusive to landlord rules, where you couldn't remove tenants that weren't paying. And and it caused some heartache. Whereas in Florida, we just didn't see that. We had, a significantly higher collection rate in the state of Florida through the pandemic than we did in Georgia. And those are our two, our two data points. But I would tell you that Georgia had a heck of a lot better collection rate than New York or California. So. I think that property rights mean something in the state of Florida, and I think that was reinforced throughout the pandemic by the administration.
Let's talk about taxes for a minute. I mean, one of the great things about investing in Florida is there's no state income tax. And that's nice, because a lot of the beef I hear about people about investing in private real estate is they hate the fact that they may end up, if they invest in a fund or something, they may end up having to file in 6 or 8 or 10 states just from that one investment. What are the tax implications of investing in your turnkey properties in Florida?
Yeah, well, I mean, Florida obviously no state income tax, so it's and that's one of the reasons that Florida is growing so fast. We've got over 21 million people in the state, growing at over 2%. We're at over 400,000 people coming to the state every year. So we have more than 1,000 people a day coming to the state of Florida, and I don't think it's any secret that a big part of that is the fact that we do not have state income tax.
In fact, for me, Jim, many moons ago, about 18 years ago, I left California. I 1031 to exchange a number of my investment properties out there into properties in the Jacksonville area. And I said, wow, when I moved here, I saved 9.9% on my money. And so I always gave that quote, Hey, when I did this back in 0405, I moved my property, 1031 exchange, was able to go into more, and I saved 9.9%. Well, last year, someone said, hey, you need to stop saying that. And I said, well, what do you mean? It's now 13.4%. I said, no way. So it actually went up about 4% more, which was a big aha for me, because when you start to really add up those numbers, where it went from 9.9 to all this, could that continue? Normally things continue in a certain direction. So that's a real big thing to consider, because that does start to compound, especially when you're a long-term buy and hold investor like yourself.
Yeah. I
Yeah,
can't
for
tell you how
sure.
many of our investors have bought properties from us as investments. And then, within a year or two, they're living in the state as well. you know,
Yeah. Who would you say is your ideal investor?
Our ideal investor is someone who's looking, when for the white coat community especially, and we've worked with a number of them, is someone who really enjoys what they do. And like I've said to you, my own history of the medical career, like, please keep doing what you're doing. I give all my family reasons of things that white coat people have done. They like their career, but they want to have supplemental income. They want to buy back their time. They don't want to create a second or third job. They're looking to build a small portfolio with us, that they can leverage off of and earn an income off of, without too much involvement. They're wanting to plug into a system, not create a system. So most of our people that I work with of your type, they don't want to be, they want to be involved, but they don't want to be in the trenches active every day and every weekend. That's what they want to avoid. They want to spend that time with their family. They want to be able to do their hobbies and have a supplemental income building off of that, and something for the future, whether it's for their own future, for their retirement, for legacy properties. That's who we've really been able to have the strongest relationships with. And those people normally step in and they will work with us, see our processes, see our results. And normally our most successful investors are buying between 3 and 8 properties with us. And they see it as this own solid soldier little business, Jim, that again, they plug into our system. They understand what's going on. They're in control, but they're leaning on us. And they don't want to, they're not enticed by all the shows of, gosh, these fixer-uppers are so fun. Because most of them have found, Chris and I did way too many fixer-uppers to know that they're not as fun as the TV shows show. And most of your people are the same. And they want to just plug into something that's proven to work, and they can have a side business of real estate without having to recreate it from square.
Yeah, it's funny you mentioned that. That what I recorded just before this webinar was a podcast interview with a gentleman who does wholesaling and fix and flipping, and that was his big takeaway at the end. This is not passive. This is very much an active endeavor. This is a side gig. Maybe it grows into your full time gig. It is not even. He didn't even want to use the term investment with it, And it's true. It's a job.
Yes.
And the nice thing about a turnkey opportunity is you get the benefits of owning the whole property, but you don't have to do any of the management stuff. You don't even have to do the buying and selling of it. I mean, that's the whole benefit of a turnkey. You get a property with a tenant in it, and you go from there. But let's talk a little bit about what it takes to get in here. I mean, how much money does somebody need to bring in order to buy one of these houses that sell in these build to rent communities you're building?
Yeah, the starting point to get into one of our single family homes is only about 65,000. So that's our initial buy-in, and obviously it'll go up from there depending on the duplex or quad that you're buying, or investing in. But starting point is 65,000. And the good news, Jim, which we love about real estate, and I know you and I have talked about this personally, is you're leveraging. You're buying a $500,000 asset. If it was stocks, you'd probably have to put up all 500,000. With this, we have really good financing options where you're putting up anywhere from 20 to 25% down and leveraging the rest, especially through our 4.75 program. So the buy-in points are at a great spot, and definitely doable for most of our people. And as you know, for some of our people that might say, hey, we're looking for just a little more write-off. We're looking very long-term with our property. We do now have, and I know people, wait, say that again. We do now have a 100% financing program. So the 100% financing program can actually get you in at only a few $1,000s. Now you have to have good credit. And when you're putting nothing down and having a little higher rate to get 100%, you will have some lost cash flow each month. But some people would rather keep their money in the bank and then look to refinance in 2 years. So that is an option as well that gets it even lower through the 100% financing.
I imagine they have a little bit of a hard time being cash flow positive, putting nothing down, though.
When you do that, yeah, it's a different play that some people like. You will have a negative cash flow. But some people say, I'd rather keep that 25% in the bank. And we believe with where the direction of it's going, I'd rather take a loss and it's a good deduction for me. And then within 2 years, I'm going to refinance it down to a lower rate anyway. That could get it into a better place. So it's a leveraging technique. It's something, to be quite honest, Jim, I would have done 20 years ago, but today me and Chris are kind of the old guys and we're a little more conservative than that. But it is an option that some people are using.
Okay. Now you guys are doing quite a bit. I mean, this is this is a turnkey opportunity, meaning it's basically a passive investment to the investors. What should they expect to pay you as far as fees go?
You want to talk about management, Chris?
Sure. Yeah. We operate both the building company and a property management company, and when the property is rented, we are charging an 8% property management fee on collected rent only. So if we don't collect the rent, there is no 8% fee. In addition to that, we also lease the property up front. So the property may or may not be rented at the time that the buyer buys the property. The investor buys the property, but we will handle the lease up for the investor post closing, or maybe lease prior to closing, and that is a charge of 75% of the first month's rent when that property is leased. And beyond that, if there's any sort of other maintenance that needs to be handled, our teams will handle the maintenance requests along the way. If there's ever a turnover in the property, our turnover teams will go in. They'll make the property ready for the next tenant. The main thing that the investor needs to do, in this transaction, is obtain the loan. So they have to get financing. They do have to get insurance for the property. And those things, and they have to pay the tax bill. Those are going to be the bills that are really going to come to their house that aren't going to come through the property management company. And of course, if they want us to pay them on their behalf, send them to us and we'll pay them. But those are the items that are typically being paid by the investor. So again, it's not a completely passive investment, but it's a very low intensity of involvement from the investor standpoint.
Okay, so let's say somebody buys one of these houses and, tenant in it, they're getting paid rent, everything's going okay, but they just decide they don't like you guys anymore. They don't want you managing the property. How long are they locked in with you, and what does it take to get out and manage it themselves or find a different property manager?
Sure, yeah. So if they just say, hey, we want out, there's a 2-year initial time period that is their contract. And if they want to get out before that 2-year period, there are two ways. One is if we've just done something terrible and there's cause, then there's no charge to leave. If they just say, hey, you know what, my brother opened up a property management company, I want to move my properties over there, then there's some sort of fee to break that management agreement, depending on how much time is left on the agreement. It's not overly burdensome. But it does vary depending on how much time's left in the agreement.
What percentage of people that bought a house through you end up moving on with some different management solution rather than just using you to manage?
It's very, very small. We were actually just looking at that the other day. So there's about a 2% cancellation rate in our property management company right now, which means we have about a 98% retention rate.
Awesome. So as you look at the real estate industry over the last year, I've heard lots of red flags, lots of worry, lots of companies struggling. Part of it was the rapid rise in interest rates, maybe putting some downward pressure on prices. What are your biggest concerns with the real estate industry looking forward?
I'll tell you what, we saw a lot shake out over the last 6 months. Man, in December of last year, I was biting my nails. It was definitely a weird time in the market. We saw national home builders really pulling back on starts. We saw development projects, getting put on hold, across the country, even in Florida, which, we're we're fairly insulated from the rest of the market just due to the rate of growth in Florida. Um, and we saw reductions in asking prices on properties. So it's been just this very weird dynamic where material costs have been rising and rising and rising, all the way to to near the end of 2022. Material costs were going straight up. So build costs, were going up, and as a result, home prices were going up. Well, what happened is, over the last 6 months, that build cost, it hasn't come down, but it's leveled off very, significantly. What that means from a builder standpoint is, we've been able to reduce our contingencies, that we were having to add significant contingencies on all of our pricing, through 2022. So what that's done is it's had a cooling down effect on pricing, because we're not having to build in a 10% additional contingency on every single build because prices were going up so fast. So we've actually seen our price points level out. So our price points are now level with the highest sale points that we've had, and we're actually able to keep that level. But yeah, so we've seen that the price points have continued to rise as closings have happened, but we've been able to level that out. So we're seeing a real stabilized effect on housing pricing in Florida. We've seen pullback in some areas, and we've seen just a leveling in others, but it's basically stabilized. Which, as a real estate investor, it's odd to hear a builder say, we're thrilled for stabilization, but we absolutely are, because in our business, we need those prices to stabilize to let those rents catch up. Rents have been climbing and climbing and climbing, but it was hard for those rents to keep up with the rapid material cost increases. So a flattening of cost, a flattening of pricing, with rents now starting to rise again. Rents had flattened and even dipped a little, and now they're starting to tick back up, and we're starting to see rental velocity in most markets, not all, but most markets. We're starting to see velocity move back in the right direction. So, this is kind of a take a breath and a breather period, that I think is a really, really good time to be in the real estate business, because, from what we're seeing in new sales contracts, not only in our business, but in the retail side of the business. So as I mentioned earlier, we were bought by Sumitomo. Sumitomo completes, I don't know, something like 25,000 houses worldwide, and about 6,000, 7,000 of those are here in the United States. And their retail side of their business had the best month that it's had in April since 2021, which is when sales contracts were screaming through the roof. So I feel like this stabilization, a lot of people are out there going, hey, okay, the prices have stopped going up, but now everyone's starting to think that interest rates may go back down again sometime at the end of this year, beginning of next year, which is probably going to cause an additional run up in demand, because there's been such a shutdown on supply. So in every single one of our markets, we really tamped the brakes on how much supply we were putting, on the ground, as did every other home builder. I mean, we saw permits decrease by 50% in every single one of our markets. So this is a market that was already constrained from a supply perspective, that now is going to have further constraint because of these development projects that got put on hold, these homes that didn't start. And now we're starting to, get at least some indications that interest rates might start to ease. I think it's a recipe to see another run up here in 2024 and 2025.
Over the last year and a half or so, public real estate has been hammered. The Vanguard REIT Index Fund has basically fallen close to 30% from the end of 2021 until mid 2023. What have you seen the values of the properties that you've been, selling in these build to rent communities? How much did they drop in that time period?
Well, I would tell you, in that time period, they've gone up significantly. So from anybody that bought a home from us in 2021, man, they are sitting pretty. We'll buy we'll buy it back at what we sold them for. I mean, they really because prices, the build costs just went up so significantly during that time period. it was just unbelievable. I mean, I could show you a chart. I could share my screen here if I could figure out how to. If you look up the producer price index that's put out by the Federal Reserve, I mean, it's just mind boggling how much costs have gone up. So that just rose the tide of all of these property owners. I would tell you, right now, as I mentioned, if you close on a home today, you can't expect that same rapid growth that you saw from the 2020, 2021, 2022, in through 2023. It's not there right now. It's flat. But I think it's coming. I think we've started to see in some markets prices tick up slightly, not the 30-40% that we saw over the previous 2 years. But we're starting to see the results of this constriction of supply, because if you think about it, December, January, these are the months, November, December, January, these are the months that homes would be finishing in right now. So, everybody really tamped the brakes November, December, January, and we would have those houses coming to completion right now in May, June, July. And so we're just at the very beginning of seeing that lack of supply hitting the market. And so, we've yet to see how that's going to affect the market. But, we saw what it did before, constricted supply, lowering of interest rates, typically has a positive impact on housing prices. So that's a long way to say, everybody that bought in 2020, 2021, and 2022, the value of their home is probably significantly more than what they paid for it. If they bought it from us in 2023, if they closed on a home in 2023, it's probably flat. And I would say that they're going to see that growth, that significant growth in the probably 2024 and 2025 time periods.
Now, if I come to you and buy a house, how long until that house is finished and has a renter in it? What's the gap period between
That's,
when I
that's
first
a quick time frame. You can close on a finished house, Jim, in less than 60 days now. The good thing about joining forces with Sumitomo, we really have a good backing to be constantly building our properties, so there's not a long delay anymore. Gosh, during the pandemic, when supply chains and everything, before we had this partnership, you could be waiting 16 months. Now it's less than 60 days to have a completed single family home, duplex, or quad. So if people are looking to move, or you might have people in the 1031 exchange, they're selling a property and they're wanting to move the equity forward, tax deferred. We're able to help a lot of people right now fulfill those 1031 exchanges. Because we have, as 1031 exchange, you have to close in less than 6 months. We're having no problem doing that right now.
So the houses are actually being built before they're even sold.
Yeah, we're on a constant rotation now, where we're confident enough. We were pretty scared to do that, especially before we had a great partner. But Chris and I joke, now that we've done over 2,000 units, we feel like we're just getting pretty good at this, and so we're confident to keep building through and have a good enough following with people like White Coat that the orders are being taken. So we're happy to keep going.
Yeah, and I think, and again, it just goes back to, we're always trying to find solutions for our clients. And, our clients were saying, hey, with this interest rate volatility, we're just having a really hard time, contracting on a home pre-construction. Now we're starting to see some of our clients coming back, and, one of the benefits of build for rent is, people are able to kind of plan their investment strategy. So we're starting to see some folks coming around looking to buy homes in earlier stages. If maybe they're planning, they've got a liquidity event that's coming up in 5-6 months, and they want to make sure that they have a home locked in at at current pricing, before prices start to go up again. We have started to see some clients coming back to that, with the thought that interest rates are going to ease. But still, to Jim's point, I'd say the vast majority of our clients are still, nervous about this interest rate volatility and looking for quick closings to mitigate that potential risk.
Awesome. Well, for those who didn't hear at the beginning, I've been talking with Jim Shields and Chris Funk. They're with Southern Impression Homes. Best link to get there is whitecoatinvestor.com/SI Homes. But we've been talking about their investment opportunity in Florida. Essentially, you get to buy a turnkey home. You own the entire home, but you don't get any toilet calls. They put the tenant in, they build the home, they sell you the home, they help you sell it when you're done with the investment. They do the property management. They take care of everything, but you get the benefits of owning the entire home, including that depreciation and the control of when it is sold, rather than having, a fund manager or syndication manager selling that when maybe you don't want to have those capital gains. So thank you so much for coming on and doing this webinar with us. Are there any last words of advice or wisdom that you have for our listeners today?
All I'd say, we've really enjoyed working with the White Coat community. The way I see it is you guys are really giving a strategy, and in real estate, funds and syndications are fantastic. We personally invest in them, but we also personally invest in direct property ownership. And that's where we feel we can really help the White Coat community, supplying that without the headaches, able to buy back your time and spend that time with your family and let us supply the supplemental income for the rents. And that's what we're here for, and we look forward to doing it.
Awesome. Thank you so much. Appreciate your time today.
Thank you.
Thanks, everybody.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.